Hey, Steve Saretsky here. As always, this is Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. I want to quickly touch on the CMHC program that I discussed last week. It looks like just preliminary details that the maximum purchase will be just a shade over $480,000. So it appears we're still waiting for some of the data. Even the mortgage brokers don't have it yet, but it looks like the max purchase price will basically be under $500,000, and that is assuming again that the first-time buyer has the maximum income of $120,000. So I mean, let's call a spade a spade. For the most part, people that are putting down less than 20% and getting a insured mortgage through CIB or through CMHC, and then vice versa, are going to give up a chunk of their equity to partner in that program, likely aren't earning $120,000. Those are likely buyers that are earning maybe $50,000, $60,000 a year. So that would put your max purchase price at around $200,000, $250,000. So again, I think that's. But this is, as I mentioned, I think this was all intentional. This lending sharing program has actually been mentioned in the book House of Debt. As I've mentioned, I've been really talking about this book for the last 18 months. If you haven't been following along, it's been very, very simple. Evan Siddall's referenced this book numerous times. In fact, his entire playbook, including your mortgage stress test, reducing the role of credit growth in the economy, to sort of scale back wild home price inflation, is all in this book. So CMHC, Canadian policymakers, regulators have given you their entire framework. Again, as I mentioned, I've been talking about this book for the last 18 months. So, and people seem to be confused or questioning these policies. But again, all you have to just read the book. Very, very simple. Again, I've been giving this advice here for the last 18 months, so it really shouldn't come as a surprise. I totally understand where they're coming from. So we'll get into loan growth. If we want to discuss loan growth and what these policies are doing, if you want to look at, as I mentioned earlier, the number of total mortgages outstanding. So the number of total mortgages outstanding in not only on a year-over-year basis, not only in Alberta and Saskatchewan, have actually turned negative. So you actually have negative year-over-year. So basically the total number of mortgages is actually shrinking in Alberta and Saskatchewan, and primarily because of weak economy, stress tests. But basically, if you're in a bad economy and you're not feeling confident of the economy, the last thing you're probably going to do is go and take out a $300,000, $400,000 mortgage and buy a home when you're not really so sure about your income growth, or even if you're going to have a job moving forward. So that's primarily part of the reason why you have loan growth negative on a year-over-year basis. We look at BC, which is, again, you could probably argue is the frothiest province in terms of housing inflation. Total loan growth in BC as of December 2018 has dropped down to 0.2% growth on a year-over-year basis, which is very, that's very, very weak growth, particularly when you want to factor in the net migration flows here coming here for work, because you have a strong economy, and of course that strong economy is basically backed through a housing boom, which is obviously not a very sustainable way to build an economy in the long run. It's kind of prone to the booms and busts of that. But so you have loan growth basically likely will dip into negative territory here in 2019. So again, these are all policies that have been brought in to curb mortgage credit, and the main driver of home price growth is the growth in credit. You have the typical home in Vancouver costs. The cheapest home that I can say in the city of Vancouver is probably like $400,000, $500,000. That's kind of your entry level point. And so, let's call it what it is most people aren't dropping $500,000 cash. Most people are reliant on a mortgage, particularly in valuations. You go to single family housing, the minimum purchase price is going to be like $1.2 million. That's going to get mortgaged. So the access to the mortgage credit growth is going to basically tell you, it's a sort of a leading indicator in terms of where home prices are going. And the role, again, in that book that I just mentioned, House of Debt, but this is not a new phenomenon. It basically illustrates the impact of household credit growth to actually propel the economy, because we're in a credit-driven environment. Money is essentially created fictitiously out of thin air through new bank originations. That's just how the money supply is actually created. 90% of the money supply is created when banks issue new loans. So obviously when banks slow down their new loans, you're essentially contracting the growth in the money supply, which ultimately contracts is basically spending, and the overall economy starts to slow. And then we're going to probably see that more as the economic backdrop begins to slow. What we've seen is the bond market has basically pushed long-term yields lower, which has basically inverted a large part of the yield curve. They say, well, this is generally an indicator of future recession, usually within 12 to 24 months. That's generally you've never really had a recession without some sort of yield curve inversion. Almost always that's the case. But people ask, well, how? What does that mean? Well, I think it's more so to do with banks looking at that as a signal, seeing the economy start to slow, and then they contract their lending. And again, as we just discussed, banks create 90% of new money through issuing loans. So obviously if the bank starts to slow down their loans because they don't feel it's a little bit more risky to loan in this environment, then they can begin to vice versa contract their loans. So I think that's more so why the economy slows after a yield curve inverts. I think it's more so just an indicator to your banks to be more cautious in your lending. And again, it's so simple. This is not like an opinion or anything. It's simple data. I mean, we can look at let's look at the last credit boom that we had. Let's look at the last credit expansion of this cycle. All you have to do is look at household credit growth from 2013 to basically late 2017 or into early 2018. You can see year-over-year growth in household credit growth was clearly in an upwards trajectory and has now slowed, I believe, to the slowest pace since the early 2000s, 2001. And that's a similar case with residential mortgage credit growth. I mean, residential mortgage credit growth is now, in February, slipped to its weakest pace of growth on a year-over-year basis since May of 2001. So we look at that, and your mortgage credit is very benign. You've obviously had a pullback in Chinese capital flows. We are well aware of that. But the fact of the matter is you have year-over-year residential mortgage credit growth growing at the slowest pace since 2001. Is it any surprise that Vancouver home sales in February were at the lowest since 1985, and simultaneously in March, we have the preliminary figures, March will come in at another 35-year low. So this is again for the month of March through all of Greater Vancouver, whether you're looking at detached homes or condos. If you take all those segments combined, it will be a 35-year low in sales. So this is not something that, it is an opinion or where's the market going. How do I feel? Do I like the mountains? Do I like the water? Is there population growth? I'm really just focused on the data. I mean, I can have an opinion about the city and, have a bullish long-term outlook. But the reality is that I'm just going to let the data speak for itself. So it's funny because people ask me, they go, well, hey, how's the market? What's going on? I hear it's kind of slowing. Well, I mean, it's a 35-year low in sales. What do you want me to say? I mean, I could talk about open house activity. I could certainly talk that open houses appear anecdotally to be busier. I could say anecdotally that I'm working 7 days a week, showing buyers around almost every single day, that I'm insanely busy right now. But at the end of the day, the sales volumes speak for themselves, that you have a 35-year low in sales, and your mortgage credit growth is at the weakest pace of growth in basically 20 years. So that's just the trajectory, and so all we have to do is watch that data and say, well, if you have a 35-year low in sales, clearly we have an impasse. We have a problem with the elevated asking prices that the sellers are asking and what buyers are actually willing to pay. So you basically have this standoff. You have this huge gap between every offer is coming in as a low ball today, for the most part, and sellers aren't really willing to come off their asking prices because they're looking a couple of years ago what their neighbors sold for. And of course, real estate is not like the stock market. People are emotionally tied to their home, especially like if you look at a detached home. No single family house is the same. They're all slightly different. And so everybody, when you live in your home, you've built up your memories over the last 10, 15, 20 years. It's an emotional thing. You become emotionally attached to the value, and of course, subjectively, everybody thinks their home is worth more than anybody else's home because it's their home and I decorated it. It's not like the stock market where you click, boom, and you sell it, at the click of a button, and you don't care. I don't care what the S&P is doing. I don't care what this gold mining stock is doing. So. That's just why home values take so long to fall, and that's why basically there's been so many studies on this, is that it takes basically volumes peak out usually 2 years before prices actually start to decline, because there's just this very prominent moment of price discovery. So again, that's what we suspect that we're going to continue to see. I mean, as long as sales volumes chug in at 35-year lows, I mean, that's just going to continue to put more downwards pressure on prices. We're seeing inventory in the condo segments doubling on a year-over-year basis. You still have 40,000 units under construction, and you have another 25,000 units that just stuck to shovel into the ground. So you got a lot of supply coming, and you have very few sales volumes. And it's funny because everyone's talking about how maybe gloomy this outlook is, and the reality is like, well, hey, great, if you want the sales volumes to pick up, if you want your commissions to pick up, if you want the market to get going again, you better drop your price. That's the only way to increase the sales volumes at this point. This is very, very typical of a housing cycle. This is like, you cannot draw this out to be any more textbook. It's really, honestly, I just find it completely fascinating to watch. And this is really not, like, this has not been, none of this has been a surprise, other than maybe the data, in my opinion, was worse than I actually anticipated. For my belief, as I said, I felt that the market was going to slow. I felt that prices were going to come down. I felt that we did have a household credit bubble. That was really the main issue in the housing market. Yes, we know the role of Chinese money. I'm not denying that, but that this was going to suffice. But just to see how things are developing, I think is truly fascinating, because it actually is all falling into place as if it's like perfectly written in an old history textbook. So we'll continue to monitor that. I mean, that's pretty much all I got for this week. Just looking at, again, I think some of the head fakes where a lot of these videos and the content I put out is ultimately trying to not only document my truths and my passion for finance and the housing markets, but also to cut through the clutter and try to help people the best that I can. So I just look at a recent headline that came out like today when I'm filming this Friday on BNN, and I like the guys at BNN. I do some interviews for them, but the title was Canadian GDP bounces back on the backs of a resurgent housing market in January. And I'm like, huh? What? What? Look at the sales figures for Canadian home sales in January. I mean, I think there were like I think it was a 10-year low actually in January. It certainly was in February. So I'm not really sure what the title was all about. Housing resurgence. So if you actually strip apart the Canadian GDP numbers in January, the majority of the growth in the GDP came from the real estate and construction sector. So they said rental and leasing agencies were and sales agencies reported growth on a month-over-month seasonally adjusted basis, and residential construction bucked the trend of something like 7 or 8 consecutive months of contracting. Actually picked up, despite housing starts continuing to slow and drop off. So I mean, that's something where I mean, not to give trading advice, but I would probably fade that rally. I mean, if your growth for January is being derived from a housing market that is clearly in the process of rolling over, probably not a sustainable growth model. So I mean, just look at retail spending, retail trade, which is basically 65% of GDP. That was flat on a month-over-month basis, 0% growth. Certainly not an encouraging sign. So that's, for me, just trying to cut through some of that. You know, hopefully people don't get sucked into stuff like that. But yeah, that's all I got for this week. So I hope that helped. Otherwise, see you next week.